All right. So today we are going to be looking at something new, how to trade futures on Binance. So before we do that, we will need to transfer some foreign funds to our futures account. So here we are on the wallet. So we click on transfer. So we are moving the coins from our spot wallet to, we choose USD's margin futures. So what we have is USD Theta worth $106.8. So we take maximum, then we transfer. So transfer successful. Now let's check it out on futures. Okay, so here it is, $106.86. So this is our margin. Looking at the top, we are at USD's margin futures. We have the coin margin futures, we have options, we have battles. So but that is not what we want to look at today. So we quickly go to USD margin futures. So if you check on the pairs that are being traded on the USD's margin future, you can click on BTC USD Theta. So you'll see here that the pairs, the coins traded are being paired to the USD Theta. All the coins traded are being paired to the USD Theta and they are on perpetual. Whereas if you click on coin margin futures, you'll see that the coins are being paired to USD. The coins are being paired to USD and some of them are perpetual while others are quarterly. So let's concentrate on what we are on today. So like you just saw, you can choose any pair you want to trade. You can choose any pair you want to trade. There are a lot of them, a whole lot. So you choose that which suits you. But today we'll be trading BTC USD Theta and looking at you can check out the analysis. Looking at the top, you can see some candlesticks. You click on them. So this is a chart. You can actually do your analysis. So here we have the line chart. Looking at time frames, we have the 15-minute time frame, 1 hour, 4 hours, the daily time frame, and more. So you can actually select, maybe you want 1 minute, 3 minutes, 3 days, 1 week, 1 month, and so on. So let's go back. All right, now if you look critically, you see the prices of Bitcoin changing so fast. That is because of the demand and supply in the market. So let's get some few things noted before moving on to trade. So as you can see on your screen, we have the open long and the open short. The long simply means buy and the short means sell. So if you want to buy Bitcoin, you simply take long, and if you want to sell, you take short. All right, so at the top of your screen, you see what is called isolated. Click on the drop down. Now when you want to trade crypto, they say switching of margin mode only applies to the selected contract. Now when you are on isolated, that is when trading and you're on isolated, it therefore means that your account is being risked only to the open trade. But if you come to cross, switching of margin mode only applies to the selected contract. Now if you come to cross, you realize that your account is too exposed. That means if you have more than one trade, your margin will be shared among all those trades, and it will cause your liquidation to be so close. So if you want to trade, it is advisable that you deal on isolated. That means you are protecting yourself such that your funds should not cross that which you have apportioned for the trade and start consuming your balance. So it's always advisable that you deal with isolated. All right. The next thing we'll be looking at is a leverage. The leverage. Now, this is a distinguishing factor between spot trading on Binance and futures trading. Now, with a leverage is just like the exchange. If you're using Binance, the exchange borrows you money to trade. So it therefore means that you're trading with more than what you have. And with this, it makes you to become more profitable if your predictions are right. So let's quickly have some explanations as far as the leverage is concerned. Now let's look at this. Let's say if you want to trade $100, that is what you're staking, and you decide to choose a 1x leverage. What you will be trading in the market, that is the value, will be $100, and your liquidation will be 100%. This means that if you are trading $100 in the market, since you have chosen 1x, it will appear as $100, and for you to lose that $100, it means that Bitcoin, if that's what you're trading, needs to go against you by 100%, which is very difficult. So if you bought, and then it means that Bitcoin needs to fall 100% before you lost the $100 you're trading. So let's look at the next. Let's say you stake $100 and your leverage is 2x. So what will be in the market is $200. What you actually own is $100, but the exchange now has given you some money for you to trade. So what you'll be trading is $200 instead of 100, and your liquidation will be 50%. It therefore means that if your prediction goes against you by 50%, then you're out of the market. So the next is $100 5x leverage. So what will appear in the market is $500, and if it goes against you by 20%, then you're out. So the next is $100 stake. A leverage is 10x. What you'll be trading is $1,000. So on your account, your $100 will still reflect, but what will be representing in the market that you cannot actually see is $1,000. That's what will be working for you. And the leverage is two-sided. It works in your favor. That is, it gives you more profit when your predictions are correct, and when it's against you, when your predictions are wrong, it also consumes your actual funds very fast, just the way it gives you fast returns. So we look at the next $100 stake, 50x. The value in the market will be $5,000, and if it goes against you by 2%, you're out. The next is $100, and your leverage is 10x. What will be in the market is $10,000, and if it goes against you by 1%, your account closes. Very risky. And what the last on our list, 100% stake, 125x. That is the highest Binance offers. What will be in the market is $12,500, and if the price of, let's say, Bitcoin goes 0.8% against you, you are off. So that is it for leverage. You choose your leverage wisely depending on your risk appetite. So let's quickly continue. So here, let's say we want to choose, you can actually add or subtract your leverage just by dragging it through. So that is it. So the higher your leverage, the higher your risks you're incurring on your account. So let's take something low. Let's say we are dealing with 10 leverage. Alright, we confirm. Okay. So we want to take a buy order. So as you can see, the price of Bitcoin has been falling for some time now, and currently there is a retracement in the market. So let's quickly take a buy trade. So we don't want to trade everything we have. Let's say we want to trade 50% of the $106 we have. So we click on buy. Successful. So this is the position here. It is open, and we are currently making a little profit. So you see on your right hand side the percentage, the returns on investment is in percentage, and on your left hand side you have the value in dollar. You can see the size of the position, 0.016 BTC. The margin is $52.65 involved, and then the risk is 3.97%. So we actually entered this trade, that's the entry price, at 32,870, and the market price is now 32,886.56. So it's in our favor. Now we have the liquidation price, which is 29,698.51. This liquidation price actually means that if the trade starts going against us, that means if Bitcoin starts falling and it reaches this 29,698.51, we will lose all we have staked in this trade. Now I spoke about isolated and cross. Now since we are trading on isolated, if we reach our liquidation price, what we will be losing is our margin of $52.65. That is what is at stake, because we are trading on isolated. But if we would have been trading on cross, we would have exhausted this $52.65, and the balance which is in our account would have also been involved. So that is why it's good to trade on isolated. Another thing is that since we cannot keep observing our trade manually, you can actually adjust the leverage here. So you can increase the leverage when a trade is open, but you cannot reduce it. So if a trade is in your favor and you feel like increasing the leverage to benefit more from the market, is good, but when it starts moving against you, you will not be able to reduce it. And remember that the more your leverage, the more your account is being exposed to risks. So will not be increasing our leverage. Alright, you move to the next, which is the stop profit and loss. You click on it. Here you can actually set your stop loss and your take profit. So our entry price is 32,870. Let's see if the market moves up to 32,900. That is relatively small. Let's say to 33,000. So if the market moves up to 33,000, we'll be making a profit of 2.08 USDT. So we take confirm. So we have set our take profit already. You can check on, because we are currently on positions, you can check on open orders. So on open orders, you can see there the condition. Market price, once it reaches 33,000, it closes. So let's move back to positions. You can as well set a stop loss. You click on it. So our entry price is 32,870. Let's say if the market moves against us to maybe 32,850. So if it goes to 32,850, it should close, and it will be closing at a loss of 0.32 USD theta, and we set. So it also goes to the open orders. That is where you can check it. Alright, so the next we have is close position. Maybe if you want to close your position instantly without waiting for a stop loss or a take profit to be met, you come in here, you decide the percentage of your trade that you want to close. Maybe you want to close 50%, 75%, or 100%, and then you take confirmation, and that will be it. So we don't want to close it now. And also, if you notice, we actually opened the trade on market. So if you click the drop down, you see limit, post only, spot, and many more. So if you want to execute the trade, let's say on limit, you click on limit. Let's choose something else to trade. Maybe let's say, or better still, let's use BTC, but it's on limit. So let's say we are trading 25% of what we currently have. 25%. Okay, so the market price is 32,872, whereas our limit price is 32,873. So you take buy. Oh, we didn't do it rightly, so it has instead gone and modified the previous trade. So let's do it again. So with the limit price, you can actually set the price at which you want to buy or sell. So let's say we are using 25% of our account. Okay, the current market price is at 32,884. Let's say we want that at the price of 32,000. At the price of 32,000, we should be able to buy. So when we take long, we open, it comes as a pending order. Check it on open trades. So that is it. Limit / open long. So at 32,000, that means if the price of Bitcoin falls down to 32,000, the trade should execute as a buy trade. So you can actually set your own price that you want to deal with in the market. That is possible with a limit, and also the spot, also the stops work similarly as a limit. So now when you're dealing with a limit, it gives you the possibility to choose your price to deal with in the market, and also it has lower fees as compared to the market. But with the market, it's quick execution. Now if you see a good entry position in the market that you need to trade, it is preferable you go in using the market to take advantage of it at once, as compared to the limit. But with the limit, you have the flexibility to choose the price and also to trade at a relatively low charges. So that is it. Alright, so you can see that we are currently in profit. In terms of return on asset, we are 1.86%, and in value $1.20. So that is it for this session, and another video will be uploaded on analysis. If you haven't subscribed yet, endeavor to do so you get updated. And if you like the video, just click like, comment. Thank you for watching.